Hello students, today we are going to start the third topic in fund flow statement. The first we did statement of changes in working capital, then we did problems on determining those transactions whether it results in increase or decrease in working capital. Today the third topic we are going to discuss about funds from operations. Students, funds from operations. What do you mean by the term fund? Fund means working capital. The capital required to carry on the day-to-day administrations of the business. It's a capital required to meet the day-to-day expenses of the business. So working capital in short means investment in current assets. So students, funds means working capital. So now in this particular topic we are going to discuss how much working capital we got from conducting business operations. So by conducting day-to-day business transactions, how much working capital did we got? So here I repeat students, funds means working capital. So by doing business operations, how much working capital did we get? So here business operations means normal usual course of business transactions. It can be like sale of goods, purchase of goods, payment of expenses, receipt of business incomes, and so on. So by conducting business operations, how much working capital did you get? So it will be determined in terms of net profits. So let us go in detail, students. Please be very careful. Funds means working capital. What do you mean by funds from operation? It means how much working capital did you get from conducting business operations. So the funds you get from business operations is called profits. So the profit what we earn is called working capital. It's called funds. So students, by conducting business operations, we make profits. We earn profits. So those profits are called funds. Those profits are called working capital. The formula to calculate the profit is income minus expense. Generally, we add the income and deduct the expenses. So total the income minus the expenses. Generally, we do this in the P&L account. Credit side total minus debit side, we get profits. So students, normally, usually incomes are added and expenses are deducted. But we add business incomes and we add non-business incomes. So when we go to P&L account, generally we find the incomes are recorded in the credit side. So we record both business incomes and non-business incomes. Business income like sale, commission, brokerage, all these are called business income. What are non-business income? Income earned not related to business, which we have discussed in income tax. Rent from house property, interest received, dividend received. So all these are income but not related to business. It's a non-business income. So students, when we calculate the fund means the profit means the working capital. So when we calculate the profit, incomes are added. So we add business income and we also add non-business income. But this non-business income should not be added I repeat, non-business income should not be added. The name itself indicates it's an income not related to business. So therefore, these non-business income which is added needs to be deducted. I repeat students, the non-business income which is added needs to be deducted. It has to be deducted because it is added. It should not be added. Why it should not be added? Because it is non-business income. So remove this, deduct this. Whereas business income needs to be added, so ignore. So don't bother about business income. So business income should be added. So therefore we are not concerned about business income. That's why we have put an into mark. So therefore keep aside business income. That is not our problem. That is not our issue. So we should only look into non-business income. So non-business income is added in PL account. So deduct. Coming back to expenses. Generally expenses will be deducted in the PL account. That is, all expenses will be deducted to find the profit. But there are two expenses we have, cash expenses and non-cash expenses. Cash expenses will result in increase in working capital or decrease in working capital, whatever the case. So we are not bothered about cash expense. So into mark, it is not an issue. So keep aside. Like business income, cash expense keep aside. It's an expense where cash is affected. So therefore ignore this. You need to look only into non-cash expense. What do you mean by non-cash expense? All those transactions where cash is not affected. So these transactions, cash will not be affected at all. So cash account will not come into picture. So these non-cash expenses will not affect our working capital. But generally non-cash expenses will be deducted, but it should not be deducted. Why it should not be deducted? Because it is non-cash expense. So those expenses that are deducted you need to add. So non-cash expense which are generally deducted needs to be added. So students, in the whole scenario, only two things you need to look into: non-business income and non-cash expense. Examples of non-cash expense are goodwill written off, depreciation, preliminary expenses written off, provision for tax. All these are expense but non-cash expense because cash is not affected. So in the whole scenario, students, you need to only look into two: non-business income and non-cash expense. So non-business income which is added should be deducted. Non-cash expense which is deducted needs to be added. So you need to look into only these two issues. Students, there are two methods of calculating funds from operations. Which method you feel convenient, you can carry on. One, you can calculate with help of statement. The other, you can calculate with help of account. So I repeat students, back to brush up your memory. Fund flow, funds from operation means working capital from conducting business operations. So by conducting business operations, how much working capital did you get? So it's nothing but net profit. So students, as I explained in the previous problem, expenses needs to be added. income need to be deducted. Non-cash expense needs to be added. Just now in the previous slide I explained. Non-cash expense needs to be added. So you take current year net profit, that is profit earned in the current year. So these and all are deducted, so add back. Depreciation is an expense but cash is not affected. Loss on sale of asset is a loss but cash is not affected. Goodwill written off, prelim expenses written off is a expense but cash is not affected. Provision for tax is a expense but a non-cash expense. What do you mean by provision for tax? Amount kept aside to pay the tax in future. It's a future related expenses. So since it is future related, cash is not affected. Proposed dividend means dividend declared, not paid. So cash is not affected. So in all these examples put on the screen is an expense but cash is not affected. So add. So you take the total of add item. So current year net profit plus total of add item, you get a subtotal. Deduct non-business income. All these incomes are not related to business. Interest received taxable under other source. Rent received taxable under HP. Dividend received taxable under other source. Profit on sale of asset taxable under capital gain. Income tax refund is a non-business income. So all these are income but not related to business. So deduct as explained in the previous slide. And also deduct last year net profit. Why you should deduct last year net profit? Because it's a profit of last year. It is not the profit of our year. It is not the profit of current year. It's a profit of last year. We don't want, so remove it, minus it. So you get total of minus. So final answer, you get funds from operations. So students, this is a statement shows how to calculate funds from operations. Very simple students. Take the current year net profit, add the non-cash expense and deduct the non-business incomes. So only two items. Add the expenses where cash is not affected. Deduct the incomes that are not related to business. So add the expense, deduct the incomes, you get funds from operations. So this is how you calculate FFO. The same thing students you can calculate in the form of account. How? All add items will come in the debit side and all less item will come in the credit side. As we follow the accounting principles, debit side we take expenses, credit side we take incomes. So depreciation, loss on sale of asset, goodwill written off, prelim expense written off, provision for tax and proposed dividend. So all these expenses are to be taken in the debit side and all the incomes are taken in the credit side. So we get the answer. So let us look how to calculate FFO in case of account. See students, as I said you, take the current year net profit and all depreciation expenses and so on to be added and all incomes are to be deducted. So how we take all expenses in the debit side and all incomes in the credit side, debit all expenses and losses, credit all incomes and gains. But a small change, you add the debit, deduct the credit. So all expenses have to be added and all incomes have to be deducted. So expense add incomes minus as explained in the first slide of this class, you get FFO. So students, whichever method you feel convenient, you can follow. Either calculate with help of statement or you can calculate with help of adjusted PL account. Okay, only the format changes, but every calculations is same. Okay students, in the next class we will work out few problems on this. Thank you.